The rise and rise of Australia's public debt, a topic that's been quietly lurking in the shadows of Australia's booming economy. Debt. Yes, that sneaky financial specter that's tightening its grip on Aussies, households, and now the government itself. Buckle up because we're diving deep into how the nation ended up in this debt spiral, what it means for your wallet, and whether there's a way out. Public debt, often referred to as government debt, represents the cumulative amount owed by a nation's government due to borrowing to cover budget deficits. Over the years, Australia has experienced a notable rise in public debt, a trend influenced by global economic shifts, domestic fiscal policies, and unexpected crises. What really happened? Australia has traditionally maintained relatively low levels of public debt compared to other advanced economies. This fiscal discipline stems from a history of strong economic growth, resource-driven exports, and a commitment to balanced budgets. However, significant events over the last 2 decades, including the 2008 global financial crisis, GFC, and the COVID-19 pandemic, have altered this trajectory. Before the GFC, Australia's net government debt as a percentage of GDP was one of the lowest among developed nations, hovering around 10%. The Howard government, 1996-2007, had paid down much of the national debt through budget surpluses, benefiting from a mining boom that bolstered government revenues. However, the need for stimulus spending during the GFC saw debt levels rise. The COVID-19 pandemic marked a watershed moment in Australia's fiscal history. Massive government spending on healthcare, job support programs like JobKeeper, and business stimulus measures caused public debt to surge. Key drivers behind the rising debt. 1. Economic shocks and crisis. Global financial crisis, 2008 to 2009. The Rudd government introduced stimulus packages worth $52 billion to prevent a deep recession. While successful in avoiding mass unemployment, it contributed to the initial climb in debt levels. COVID-19 pandemic. Governments worldwide faced unprecedented challenges in combating the economic fallout from the pandemic. Australia's response included multi-billion-dollar packages, resulting in a significant budget deficit. 2. Structural budget deficits. Structural deficits occur when recurring government expenditures consistently outpace revenue. Australia has faced long-term challenges in balancing its budget due to rising healthcare costs, an aging population, and insufficient revenue streams to cover growing demands. 3. Tax revenue volatility. Australia's tax system is heavily reliant on corporate and income taxes, both of which are sensitive to economic cycles. Commodity price fluctuations, particularly in iron ore and coal, further contribute to revenue unpredictability. 4. Increased public spending. Successive governments have ramped up spending on social programs, defense, infrastructure, and education. While these initiatives aim to support economic growth and societal well-being, they also increase the fiscal burden. 5. Low interest rates and borrowing incentives. Historically low global interest rates over the past decade have made borrowing cheaper for governments. While this mitigates the immediate impact of higher debt levels, it also reduces incentives to curb borrowing. Should Australians be worried about the rise in public debt? The rise of Australia's public debt has sparked widespread debate among policymakers, economists, and the public. As gross public debt surpasses $1 trillion, around 46% of GDP, concerns about its implications for the nation's economic health and future generations are growing. While some experts argue that these debt levels are manageable, others warn of potential risks. Let's understand the context. Public debt in itself is not inherently bad. Governments often borrow to fund critical investments in infrastructure, healthcare, education, and social services, all of which contribute to long-term economic growth and societal well-being. In Australia's case, much of the recent debt surge stems from extraordinary circumstances, particularly the COVID-19 pandemic. Massive government spending on programs like JobKeeper and JobSeeker prevented widespread economic collapse and supported millions of Australians during a crisis. Additionally, while Australia's debt levels have risen significantly, they remain relatively moderate compared to other advanced economies. For instance, as of 2023, the United States had gross public debt exceeding 120% of GDP. Japan's debt stood at over 250% of GDP, the highest among developed nations. The European Union's average public debt was around 90% of GDP. Australia's relatively lower debt-to-GDP ratio provides some fiscal leeway. However, this should not lead to complacency, as global economic conditions and domestic challenges could rapidly change. These are the implications of rising public debt. 1. Economic growth and productivity. Public debt has the potential to drive economic growth in the short term, particularly when it is strategically directed toward productive sectors such as infrastructure, healthcare, or education. These investments can yield substantial long-term benefits, enhancing productivity, improving public welfare, and fostering innovation. For instance, robust infrastructure projects can stimulate job creation, efficient healthcare systems can bolster workforce participation, and quality education can equip future generations with the skills needed for a competitive economy. However, the risks associated with excessive public debt cannot be ignored. High debt levels can crowd out private investment by increasing competition for available capital, driving up interest rates, and reducing the resources accessible to businesses. This can dampen private sector growth and innovation, leading to inefficiencies in resource allocation. Governments burdened by substantial debt may also face challenges in maintaining fiscal flexibility, leaving them less equipped to respond to future economic crises or unforeseen emergencies. 2. Interest payments and fiscal pressure. As public debt rises, so do the associated interest obligations, which constrain government finances. By 2023, Australia's interest payments on its public debt reached nearly $20 billion annually. This substantial figure represents funds that could otherwise be allocated to essential services like healthcare, education, or infrastructure development. Rising interest payments also limit fiscal flexibility, reducing the government's capacity to respond to economic shocks or invest in long-term growth opportunities. As global interest rates climb, the cost of servicing debt is likely to increase, further compounding this issue. While debt can support economic growth when used wisely, excessive borrowing risks creating a vicious cycle where growing interest obligations consume a larger share of the budget. This underscores the importance of managing debt levels carefully, ensuring borrowing is directed toward projects with clear economic benefits while maintaining sustainable public finances for future generations. 3. Impact on sovereign credit ratings. Australia's strong credit rating has been a cornerstone of its economic stability, enabling the government to borrow at relatively low costs. This favorable standing reflects investor confidence in Australia's fiscal discipline and economic resilience. Low borrowing costs have allowed the country to fund essential projects and respond to crises without excessive financial strain. However, sustained high levels of public debt pose a risk to this credit strength. If debt continues to climb without a clear path to stabilization, credit rating agencies may downgrade Australia's rating. A downgrade would signal increased risk to investors, leading to higher borrowing costs for the government. This could create a ripple effect, raising the cost of debt servicing and diverting funds away from critical public services or infrastructure. Maintaining Australia's creditworthiness requires prudent fiscal management, targeted investments, and a commitment to addressing structural budget challenges to preserve investor confidence. 4. Generational equity. High public debt often shifts the responsibility of repayment to future generations, raising concerns about intergenerational equity. Critics argue that when debt is used to fund recurrent spending, such as day-to-day government operations or short-term programs, it offers limited long-term benefits while saddling future taxpayers with the financial burden. This imbalance becomes particularly problematic if the borrowed funds do not contribute to economic growth or societal improvements that future generations can inherit. However, when borrowing is primarily directed toward covering budget deficits or temporary expenditures, it risks leaving younger generations with fewer resources and greater liabilities. Addressing this challenge requires a careful balance. Governments must prioritize borrowing for productive purposes that yield long-term economic returns, ensuring future Australians inherit not just debt, but also a stronger, more resilient economy. 5. Vulnerability to external shocks. A heavily indebted economy is inherently more vulnerable to external shocks, such as sharp declines in commodity prices, geopolitical conflicts, or global economic downturns. These shocks can disrupt revenue streams and increase the need for government intervention, yet high debt levels constrain a government's ability to respond effectively. Rising debt limits the fiscal space required to implement counter-cyclical policies, such as stimulus spending or tax relief, which are critical during economic crises. For example, a government already burdened by significant debt may find it difficult to borrow further without incurring higher interest rates or risking a loss of investor confidence. This lack of flexibility can exacerbate the economic fallout, prolonging recovery periods. Additionally, reliance on external financing increases exposure to fluctuations in global financial markets. To mitigate these risks, maintaining manageable debt levels and building fiscal buffers during periods of economic growth is essential for resilience against future crises. Why you should not really panic. 1. Economic growth can outpace debt. If Australia's economy grows at a faster pace than its debt, the debt to GDP ratio can stabilize or even decrease over time. This occurs because economic growth increases the size of the economy relative to the debt, reducing the burden of debt as a proportion of national output. Investing in productivity-enhancing projects plays a critical role in achieving this balance. Infrastructure developments, such as improved transportation networks or energy systems, can drive efficiency and stimulate economic activity. Similarly, investments in technology and innovation can boost competitiveness, create new industries, and generate long-term economic returns. Such strategic spending ensures that borrowed funds contribute to sustainable growth rather than short-term consumption. By focusing on initiatives that expand the economy's productive capacity, Australia can manage its debt levels effectively, fostering fiscal stability while positioning the nation for stronger economic performance in the future. 2. Low debt compared to peers. Australia's debt to GDP ratio remains relatively low compared to many other advanced economies, providing some reassurance that current debt levels are manageable. This lower ratio means Australia has more room to navigate its fiscal challenges, especially if it maintains sound fiscal policies. Prudent management, such as controlling spending, increasing revenue through tax reforms, and directing borrowing toward productive investments, can help ensure that debt remains sustainable. Additionally, a strong and growing economy can mitigate the impacts of debt by increasing the nominal GDP, effectively reducing the debt burden relative to the country's economic output. While Australia's debt situation is manageable for now, careful fiscal planning will be essential to avoid future fiscal pressures and ensure long-term economic stability. 3. Borrowing at low interest rates. Much of Australia's recent borrowing occurred during a period of historically low global interest rates, which has helped minimize the immediate cost of servicing its public debt. This favorable borrowing environment allowed the government to secure loans at relatively low interest rates, reducing the financial burden on the national budget in the short term. Low interest rates made it cheaper for the government to fund stimulus programs, infrastructure projects, and other necessary expenditures, especially during crises like the COVID-19 pandemic. However, as interest rates rise globally in response to inflationary pressures and tightening monetary policies, the cost of servicing Australia's debt will likely increase. So, while Australians should not panic about rising public debt, there is cause for vigilance. Structural reforms, such as broadening the tax base and addressing spending inefficiencies, are essential to maintain fiscal sustainability. With prudent policies and forward-looking planning, Australia can navigate its rising debt levels without compromising future prosperity. What are the potential solutions and policy responses? 1. Fiscal discipline and balanced budgets. To ensure long-term fiscal sustainability, governments must prioritize fiscal discipline by carefully managing public finances. This means avoiding unnecessary expenditure, cutting inefficiencies, and focusing on the most productive uses of government resources. By implementing a disciplined approach to budgeting, governments can prevent excessive borrowing and help stabilize public debt levels. Achieving a balanced budget over the economic cycle is a key objective. During periods of economic growth, governments should aim to run surpluses or at least balance their budgets, allowing for the accumulation of fiscal reserves. These reserves can be used to cushion the economy during downturns, reducing the need to borrow during recessions. By ensuring that borrowing is primarily used for investment rather than recurring spending, governments can maintain debt at manageable levels. 2. Tax reform. Broadening the tax base and reducing dependence on volatile revenue sources could improve fiscal resilience. Proposals include increasing the goods and services tax, GST, while compensating low-income households, reducing tax concessions, such as negative gearing and superannuation tax breaks, introducing environmental taxes or carbon pricing mechanisms. 3. Investment in productivity-enhancing projects. Borrowing for infrastructure, education, and technology development can yield significant long-term economic benefits by enhancing productivity, creating jobs, and fostering innovation. Investments in infrastructure, such as roads, public transport, and energy systems, can stimulate economic activity and improve efficiency across sectors. Similarly, investing in education ensures a skilled workforce, while technology development drives innovation and global competitiveness. However, for such borrowing to be justified, it is essential that these investments deliver measurable returns. This means focusing on projects that provide clear economic benefits, such as increased productivity or improved public welfare. Governments must ensure that the borrowed funds are spent wisely and that the returns outweigh the costs of servicing the debt. By prioritizing high return investments, borrowing can be used as a tool for sustainable growth, making it possible to manage debt without compromising future financial stability or burdening taxpayers. 4. Addressing structural challenges. Tackling long-term structural issues, such as healthcare costs and aging demographics, is essential. Policies promoting workforce participation, immigration, and preventive healthcare could help manage these pressures. 5. Debt transparency and accountability. Enhancing transparency in government borrowing and spending fosters public trust and ensures accountability. Independent audits and reporting mechanisms could provide valuable oversight. The role of monetary policy and debt management. Australia's monetary policy, managed by the Reserve Bank of Australia, RBA, plays an indirect but significant role in public debt dynamics. During periods of economic downturn, the RBA's low interest rates have facilitated cheaper government borrowing. However, as global central banks pivot towards tightening monetary policy to combat inflation, rising interest rates could increase debt servicing costs. Coordination between fiscal and monetary policies will be vital to managing debt sustainably without stifling economic growth. The path ahead. The rise of Australia's public debt reflects a confluence of global and domestic challenges, as well as the inherent complexities of managing a modern economy. While current debt levels are manageable, the trajectory demands careful planning and proactive policies. Moving forward, policymakers must strike a balance between supporting economic growth and maintaining fiscal discipline. By focusing on sustainable investments, comprehensive tax reform, and addressing structural challenges, Australia can navigate its public debt challenges while ensuring long-term economic resilience. Australia's public debt story is a cautionary tale of how external shocks and domestic decisions shape fiscal outcomes. It underscores the importance of prudent financial management and adaptability in a rapidly evolving global economy. What do you think? Is Australia's debt situation a ticking time bomb or just a bump in the road? Let us know in the comments, and don't forget to like, share, and subscribe for more deep dives into the world's biggest economic issues.